Alrighty then. Welcome to Wednesday office hours. We're only going to go for 60 minutes because we have another thing that we're going to do over in the pod. So I'm not going to go faster. I'm just going to do a portion of this, and it will seem like it's repeating last week, but it doesn't. We've added more things to it, more ideas, and I hope you'll bear with the. I did shorten it. I made it not necessarily more readable, but I did take out some stuff from last week. So, and it's not identical. I mean, I added some stuff. So, uh, there's that. We'll see whether this is going to do the job, though, as with most things. All righty then. Welcome to Wednesday office hours. We have been looking at fictional capital. We're going to look at the additional sides to fictional capital. The idea that both credit and debt, last week we looked at public debt. This week we will consider a wider range of debt, of course, which is implied by last week because of bonds, more specifically government bonds. And so we'll now talk a little bit more about non-government bonds or less government bonds. So there's that. Unless you think that's unimportant, these are big components of the front end of fictional capital, the idea of a fictional capital. Now, where we'll wind up, or where we'll begin, is a little something by Bob Miser from Santa Cruz on the idea that you can attach value to the idea of justice as an option on accumulated wealth. And his purpose is to see how, in a revolutionary context, you can sort of redo certain ideas about financialization, which fits into what we were doing before on those 7 things that we could actually fix the economy with, that we mentioned last week, which I've put back in this week, just so you can remind yourself that there's some things would seem like minor adjustments, although, the second you try to do this with a democratic socialist government, lawfare will ensue. But that's the point of being committed to your ideas. And I think it would alter the American economy, actually make it consonant with other economies. You see, that's the thing about it, is that you're not just fixing one thing, you're fixing this entire system that includes things that are dominated by the US, the IMF, the World Bank, et cetera, et cetera. So you want to think about that. So in the present era of financialized capitalism, it is socially viable to understand that justice can and should be treated as an inherently contingent claim, the value of which remains in play, whether or not it is or can be settled by force. Now, force in this particular instance is not, necessarily physical force. Thus, the non-exercise of the option of justice, this is done by a Rawlsian, can be made to have value as well as its exercise. So option and exercise as a political matter. We can learn to speak of justice as a kind of optionality on historically accumulated wealth, and not as a fixed pattern or set of end states. So this is more fluid, we could say, more temporal, more relative as opposed to absolute, etc. So we can make a practical matter of rolling over the option of justice now, that is a final settlement, funded out of the pool of accumulated wealth. So ultimately, this gets back to what democratic socialism or other anti-capitalist ideas might come up with, but ultimately this levels out an economy, allows redistribution of wealth, and those people who make far too much money can still have all their money, don't have to lock up all the billionaires, etc. So that's one thing. I'll come back to that in a moment. Where we sort of will begin, as I've said, I have this tendency to begin from the end. Um, so Bob Meister's text, to draft on reconceiving Marx for an era of financialization, is an interesting little text. But it's written from historian's point of view, or political theorist's point of view, as opposed to an economist's point of view, which is not necessarily good or bad, but you want to think about these matters, which are part of the other side, as it were. It is, as it were, the enforcement side, or the contractual side, of what we've been talking about in terms of, and we introduced this before, the idea that fictitious capital, has contingent elements to it, one of which is legal, and it is more obviously legal relative to property, and more specifically land. So while I'm fiddling here, I will tell you what I've come across that is useful for us to think about. And where did I start? Well, I started with a bunch of things. I began thinking about pricing, and that AI is obviously being used in a lot of different sort of pricing and algorithmic models. And one among many is the idea that you could do real estate valuation. And there's a whole thing on this about machine learning, et cetera, et cetera. Valuation of land, particularly if you're selling or, whatever, buying property. And because the data is relatively secure, and there's this tremendous technology that allows for its automation, you can push that in slightly different directions, since the data hopefully remains public. And this is the usual problem of public-private, of course, and that other side of fictitious capital. But anyway, that's another story. So where I was what I was ruminating about was the idea, because ultimately we're getting to a point where we're going to talk about the indexicality of prices. So a price index is a normalized average, typically a weighted average, of price relative to a given class of goods or services in a specific region over a defined time period. So it has a spatial and temporal component, and it is indexical in the sense that it is it's a kind of average. It is not the average. It could be a weighted average, and in a spatial context, it has other issues about correlation and et cetera, that are constrained, of course, by thinking about it just in those terms. And of course, if you want to think about it in more, as we've been talking about, quantum terms, then it gains even more, as it were, complexity. So there are price indices like Las Spares, Poshka, and Fisher. There are different ways in which we think about inflation over time, and price related to that. These are key tools that have been used, or are part of the history of economic analysis and monetary policy, and they have a history and et cetera. They're tools. Compare, of course, indexicality, that is in semiotics, linguistics, anthropology, and the philosophy of language. Indexicality is the phenomenon of a sign pointing to or indexing some element in the context in which it occurs. Now, note that, of course, some element in a context begins to fit that question of how quantum events are identified in the economic context. And so a sign that signifies indexicality is called an index, or in philosophy, an indexical. You can see already that's gets complicated. So where I wound up uh, was beginning to talk about certain other ideas, particularly since this is part of my larger project on virtual capital, that we're going to get to virtuality eventually. But let's look at sort of the components of that. So rather than simply measuring price movement, artificial intelligence enhanced models read index outputs alongside demand signals, seasonal patterns, and market context to predict how buying behavior will shift, turning a standard pricing measure into a forward-looking demand forecasting tool. Now that's, predicting too much ahead, but uh, it may be trying to do too much with it because you're going to do all other kinds of things at the same time. But it's interesting to think about that because there's network analysis and spatial analysis and GIS and a bunch of other things that can be deployed uh, for these kinds of things. And yes, there's other algorithmic things that can be applied. So that's where it was headed. Note, of course, that there are more quantitative approaches to this, and constructing rules for this or mechanisms, which is very specific in that sense, or institutions that produce good outcomes according to some predefined metric, whatever that is, even when the designer does not know, this is asymmetry here, right? Does not know the player's true preferences. And the problem of truth, of course, is underlying this is also, philosophically indexical in that sense, true preferences or what information they have. So mechanism design, it's a very common term, needless to say, thus focuses on the study of solution concepts for a class of private information games. Now, the whole business of this is, skewed in the usual ways, and then there's game theory and suboptimality and iterative stuff and repeated and blah, 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 blah. But mechanism design has broad applications, including traditional domains of economics such as market design. Market making is an entire interesting set of literature, but it applies not only within the economic context or the business context, but also political science and voting theory. There's all these things that are part of calculating stuff like that and simulating stuff like that. And it fits into a whole experimental thing and methodological individualism and a whole bunch of other stuff. Doesn't even get into, Boolean questions and whatever. It is a foundational component in the operation of the internet, being used in network systems such as interdomain routing, e-commerce, and advertisement auctions by Facebook and Google. So you can see this is right in the wheelhouse of the current, cloud problems, etc. Because it starts with the end of the game, there's sort of an inductive, thing that goes on here, then works backward to find a game that implements it. It is sometimes described as quote unquote reverse game theory. And Leonid Hurwitz explains that in a design problem, the goal function is the main given, while the mechanism is the unknown. That's that backward thing. Therefore, the design problem is the inverse of traditional economic theory, which is problematic for a whole bunch of people, which is typically devoted to the analysis of the performance of a given mechanism. So you can already see there's a kind of inversion going on, and that it's arrayed in a slightly different way. So because it's etc., a typical application is a seller who wants to sell some items to potential buyers. The seller wants to price the items in a way that will maximize their profit. The optimal prices depend on the amount that each buyer is willing to pay for each item. The seller does not know these amounts, but assumes that they are drawn from a certain known probability distribution. You already can see where we're headed, right, from a quantum point of view. The phrase Bayesian optimal mechanism design has the following meaning, and et cetera, et cetera. Bayesian means that we know the probability distribution. Optimal means we want to maximize expected revenue of the auctioneer. And mechanism means we want to design rules that define a quote unquote truthful mechanism in which each agent has an incentive to report their true value. So there's a whole bunch of other contingencies built into it, but this is all part of a larger or a wider sort of set of ideas about virtual valuation. So in auction theory, particularly Bayesian optimal mechanism design, a virtual valuation of an agent is a function that measures the surplus that can be extracted from that agent. So you can already see here that this isn't written by Marx, but you can see there's other ideas here that can be that bear a family resemblance to political economic issues. So I don't want to go through a long thing here, but so I included an article on algorithmic pricing via virtual valuations. This is Chawla, Hartline, and Kleinberg. And it is a computational problem, and there are logarithmic approximations and polylogarithmic inapproximability and all kinds of other stuff in there that are part of a larger Bayesian pricing problem. So it has to do with certain priors or probabilities that are useful in designing rules for such mechanisms. Now, I went to sort of check my work in the LLM and sort of asked questions about my own work about algorithmic pricing via virtual valuations, and I include that, and it's got the usual math stuff. Also includes algorithmic performance. Now, why does this matter? This work bridges the gap between algorithmic pricing and mechanism design theory by showing the techniques from Roger Myerson, who with Hurwitz and I forget the third guy, get the Nobel Prize in 2007. So optimal auction design can be directly applied to pricing problems, providing practical algorithms for a special case that was previously considered computationally hard. Now, note, of course, that a progress has occurred since the original work by Hurwitz, Myerson, etc. But it has graphical solutions, even has an online graphic thing that I include here. And we can see the more direct application, or at least a spatial application of it, in the idea of mapping real estate values. So there are several literature reviews. So I picked one of many, but recently, so because everything is changing so quickly, not unlike the quantum political economy stuff, semi-systematic literature review of spatial evaluation methods. And so that of necessity will occur too. I included and I didn't take it out, but a third kind of graphic thing that talks about Derrida and difference, which is a deconstructive approach to the idea that what we've been looking at in a quantum sense, as well as what Zizek was doing, we talked about that last time, is the idea of difference. Things are less determinate, let's put it that way, and there are differences that the language gives us. And we know this, of course, because of the overlap that we did weeks ago between economics and language, and bridged by semiotics in that context. But it is, of course, much more fluid and less absolute and less functional or mechanical. And so that's kind of what Derrida gives us that. And then to get closer to it, kind of where we are in the history of thinking about these broader ideas. And of course, I don't necessarily agree with Yanis Varoufakis on techno-feudalism, but there is something, techno-feudal about the issue. I mean, he does it from a kind of posing, cloudal things in the cloud as techno-feudal as a kind of literary conceit, more metaphorical in many ways, but also signifies at the ground level or the material level that these relationships are, structurally uh, identical to a materialist analysis. Ultimately, I mean, that's not how he frames it, but it's kind of what he's doing. And uh, I think Zizek would agree with me on that, as well as hopefully Varoufakis. So I got to another article on a Marxian model of market for money capital. Now, profit rate, interest rate, and leverage ratio. So what we're getting down to is we're drilling down to the details of quote unquote money markets, but this is not a money, this is not an MMT uh, sort of analysis, but it is the idea that the undersubscribed, at least up to a couple of decades ago, is the idea of Marx's money theory. And I mean, he didn't forget about money. He just simply, it was never fully fleshed out. And de Brunnhoff and a bunch of other folks are part of course, and modern money theory are part of the kind of reconsiderations of these matters. And as I've said before, people who attempt to separate modern money theory from Marx are, it's not a fool's errand, but it's sort of, it has, well, anyway. So I found a working paper. This is from UMass Amherst by a fellow by the name of Hyun Woon H.W. Park. And it's useful in the sense that, well, let me just let him describe this. He develops a Marxian model of market for, and there's more direct and indirect articles that need to be edited into this, but it's a working paper, so it's not a full article that would have had all the grammar worked out, but a Marxian model of the market for money capital populated by capitalists equipped with equal money capital endowments, but with heterogeneous linear production technology. So on the one hand, you have equal endowments. On the other hand, you have something called a heterogeneous linear production technology, which makes it different from a variety or a history of more homogeneous linear production technology. And technology in this sense is not machines, but rather math or algorithms, or however you want to talk about it, but that is technology as well. So he makes certain assumptions in here that kind of come from analytic Marxism, and because he assumes certain equilibria are at work, etc. And he's got a lot of math in this. There's a lot of math that I didn't include in this. You can look it up for yourself. So let's get the general ideas. The point, of course, in introducing this one article is the idea that there is not only debt, which is what we were looking at before with bonds, public debt last week. Now we're going to think about private debt and credit. So we have to fill in all of these things that are all part of fictitious capital. I mean, we're still all talking about fictitious capital constructed with a variety of, as it were, technologies, instruments, or methods, or rules. And now his purpose is slightly different because he is more into the money side of this, and so I'm not going to sort of sell that as the higher level, but I did like his methodology because it was relatively clear or structured, and we can move further on because he reinforces certain ideas. That is the difference between um, uh, industrial capitalists and money capitalists, or merchant or financial capital. He starts out with a simple dichotomy or simple binary and then moves a little further along. And for a working paper, it's fine. There's other things that he needs to fix in the paper, but whatever. Due to a maximization of return on equity, capitalists with relatively weak technology yielding a profit rate lower than the interest rate become a money capitalist, that is a lender, and capitalists with relatively strong technology yielding profit rates that are better than the interest rates, they become industrial capitalists. So there is lending and borrowing, which is the whole point of talking about credit and debt, right? And we saw that kind of introduced with Alvis's article from last week. They're talking about loanable money capital and et cetera, uh, interest-bearing capital, et cetera. All those are still part of thinking about this. So we haven't left anything behind. In fact, if anything, we've added more subcategories, which make the whole business a little harder. Um, and of course is better for those people, Marxists, like Michael Hudson or Michael Roberts, who have worked in the city of London, and who have commercial backgrounds, who have had to do this all the time, and probably handled this better than those of us who haven't had banking. I mean, have taken money in banking courses, but actual banking, um, probably have a better shot at explaining or understanding this. So the equilibrium interest rate is derived by the associated demand and supply relation. Note, of course, that supply and demand are not as simple in Marx's notion. He knows about demand and supply, but that's not as important. It's too in some ways it's a too abstract form. Um, and also the missing portion, of course, is that demand and supply at equilibrium are more part of a parallel tradition from the 19th century that wound up becoming or supporting neoclassical economics, with its math and rules and kind of logic. Now, it's not a bad logic, and with respect, most people are actually trained in it. But the alternatives, the post-Keynesian, et cetera, ideas are kind of useful, particularly when there's so much or so many things that are asymmetric. So in this context, Marx's notion of the role of the credit system in an expanded reproduction of capital is understood in terms of an efficient reallocation of funds through the credit market. From this setup of the model follow two essential relationships that Marx establishes between the average profit rate and the interest rate. Note, of course, that he's still following this idea that you can calculate averages, and the point is that averages don't necessarily get you where you want to go, but that's we're starting at a very sort of primitive level here, fundamental level. So two essential relationships that relate profit rate and interest rate. Number one, that the profit rate sets a maximum limit of interest. So there's a profit rate setting a maximum limit for interest rates. And number two, that there is correlation between these two things, which sort of follows from number one. But anyway, lastly, or third, depending on the financial sector's leverage ratio, which is supported by its intermediation technology. Now, lest you think that that's something brand new or whatever, it is, in effect, what goes on between Department 1 and Department 2. It's how things are intermediated between the production sector and the distribution or circulations sector. It is what makes the things, it's what enables circuits of capital in that sense. So the financial sector may be more or less profitable than the industrial sector. So you can see how that benefits capitalism, economic growth, et cetera. This result suggests that one aspect of the industrial banking capitalist antagonism Surrounding the division of profit into interest and profit of enterprise lies in the banking capitalist strenuous efforts towards continuous innovations in financial intermediation technology. Now, the other way, of course, of looking at this is, auto companies are more about financing cars than making cars, at least in the American context. I'll just leave that there for you to work through. So this is Park's article, and we're just going to do the front end of this because there's about 10 pages of math that you don't necessarily need to know now. You can look it up. In part 5 of Capital Volume 3, Marx suggests, in part 5, we've been talking about part 5 of Volume 3, Marx suggests that loanable interest-bearing capital, that is the culmination of capital, is paid out of surplus value, that is profits, produced by industrial capital, and that, however, the rate at which it is paid is determined purely by demand and supply relation without any reference to the law of value. There's a certain kind of autonomy that Marx presumes that he simplifies for, because volumes 2 and 3 weren't really published. I mean, they were published, but published much later after Marx's death. And of course, more attention is paid to sort of creating a much more simple or tight version of volume 1. Volumes 2 and 3 being edited by Engels, among others. So in this paper, I present a model of market for money capital to study, within the Marxian framework, the determination of interest rate and its relationship with capital profitability at individual levels, aggregate levels, and sectoral levels. So pretty well described in that sense. The model describes an economy in one period without uncertainties. It's already, it has certain constraints on it, where only one good is produced and capitalists are equipped with equal endowment. There's Pareto conditions here, but with different linear technology. So different linear technology implies a bunch of other things. It could be use of linear programming, for example, or minimax stuff, etc., or whatever, or JIT, or a bunch of other things. The technology heterogeneity provides a basis for explaining a divergence of capital class into industrial capitalists, that is borrowers, and money capitalists, that is lenders. Now, there's an agency issue, of course, here, and underlying this, of course, is an entire political economy of contracts, but that, we don't have to go there right now. More specifically, the capitalists equipped with less advanced technology, fewer computers, poorer algorithms, generating the profit rate smaller than a given interest rate, find it optimal to manage their endowment as loanable, IBC, interest-bearing capital, whereas the capitalists equipped with more advanced technology, supercomputers or whatever, generating the profit rate greater than the given interest rate, find it optimal to manage their endowment as industrial capital. Now, there's a big deal here about the difference between those two. It's financing it not only by their own capital, but by borrowing. So, their capital requirements at scale, and the scale involves, better technologies, computer companies who have had the advantage of being able to develop some of their software using supercomputers like Apple, make strides in, bulletproofing their software slightly better. But of course, there are other issues related to chips and things, and theories of marketing, etc. But anyway. That is, in the case without uncertainty, the average profit rate, or the profit rate as total social capital in an economy of credit market with a credit market, is greater than that in an economy without a credit market. That seems, fairly intuitive. This result demonstrates that Marx's notion of the role of the credit system in an expanded reproduction of capital can be understood in terms of one of the standard results in economic theory about efficient reallocation of resources using a credit market. So, in Marx's discussion of interest-bearing capital and interest, IBC, and interest, two long-run relationships emerge between the average profit rate and the interest rate. That is, as we sort of saw above, number one, profit, that is the profit rate, sets a maximum limit of interest rate and, without going into the math, and number two, unless the share of interest payment out of gross profit is unreasonably volatile, interest rate moves in step with profit rate. So that's kind of intuitive as well. My model, that is Park's model, formally replicates both of these relationships between the two rates. So the first relationship holds since only capitalists equipped with more advanced technology, which generates a profit rate greater than the interest rate, operate industrial capital. And as a way to verify the second relationship, it was shown that the two rates respond in the same direction to a shift in each of the model parameters. This is all, sort of uh, the clerk-like work that you sort of need to do in order to prove it. And it is self-fulfilling in many ways, but it kind of, it's tautological in that sense. It's kind of, it's how the math works. So in the benchmark model, because Park is making a benchmark model against which, you can compare modifications, summarized thus far, capitalists decide to become a money capitalist, not because they have a skill in managing loanable interest-bearing capital, but, and this is a supposition that he's building into this only because he wants to isolate the differences using one variable, one thing, weak production technology. Consequently, the financial sector, lacking financial intermediation technology, cannot borrow. It is only the industrial sector that uses leverage to amplify profitability. So for this reason, the industrial sector is more profitable than the financial sector. Now, this is a very Marxian model in that sense, sort of, you know, capitalism moves further forward, of course, and industrialization happens. It happens in a elemental stage at the end of the 19th and beginning of the 20th century because of a variety of, industrial concentrations and mischief by, robber barons, et cetera, the lack of a regulatory state, the issue of taxation, and et cetera, et cetera. So, in an extension of the benchmark model, banking capitalists equipped with financial intermediation technology are introduced who can raise funds at a cost lower than the interest rate they charge on lending. It is shown that the financial sector profitability is also amplified through borrowing, and when the financial sector leverage ratio is sufficiently high, the financial sector may possibly be more profitable than the industrial sector. And that's that difference between Department 1 and Department 2, and explains, or at least it's the front end of talking about industrial policy in the second half of the 20th century, particularly in the post-war period. So this result demonstrates that banking capitalist strenuous effort toward innovation in financial technology, which enables expanding the bank balance sheet by borrowing at a lower cost, is one important aspect of what Marx describes as the antagonism between industrial capitalists and money banking capitalists surrounding the division of profit into interest, the interest of enterprise, and the profit of enterprise. So there are three important considerations of dealing with credit in a Marxian framework. So first, Marx distinguishes between commercial credit and monetary credit. And this particular paper considers only monetary credit, which includes direct lending and bank loans. There's other stuff, and that's kind of where we're going to head slightly after this. Second, Marx identifies two important sources of demand for credit. So there's demand for credit to finance an expanded reproduction of capital, more machines, etc., especially in a period when economic prospect warrants an expansion of the production scale. On the other hand, capitalists also demand credit to make debt payments, which usually occurs en masse during the downturn of the business cycle. In the former, it is demand for money as capital, i.e., the money form of capital, that could initiate the circuit of capital. Remember, we've talked about circuits and that they are overlapping but not identical. In the latter, it is a demand for money or money as means of payment. So different functionalities that money has. So the model presented in this paper considers only the former type of credit demand, that is, demand for money capital, not for means of payment. Now, this other thing here is something that we've discussed a little bit, and we note, of course, that it was discussed more in last week's installment on bonds. So in the sense that credit analyzed in this paper is monetary credit, and the credit demand arises as demand for money capital, the model presented in this paper is a model of the market for money capital or loan capital rather than a market for credit. Now, note, of course, this is the front end of beginning to talk about credit issues, or that we started with fictitious capital, and we're looking at the underlying components that are part of financialization that include stuff like credit and debt. So third, Marx discusses two roles of credit in the capitalist system. On the one hand, credit plays an essential role in financing expanded reproduction of capital, which is why the credit system develops, along with the development of capitalist production. On the other hand, an accumulation of interest-bearing capital, IBC, tends to deviate from, and now this is Park's assumption, and be independent of an accumulation of industrial capital, in which case the credit system would make the system fragile and unstable. In particular, referring to the latter, Marx suggests that the credit system precipitating an outbreak of contradictions of capitalist production. Now, some people charge Marx with oversimplifying this and doing it in order to, facilitate his, model of crisis. And perhaps that's what's going on here. But Park is doing some limited stuff. So the first role of credit is what he's focusing on, and he picks some very specific articles, Harris, Panico, Lianas, and Saros, that is, exploring the general law of the determination of interest rate in Marxian theory, against a view that there is no such law, due to Marx's suggestion that the natural rate of interest does not exist. This is a whole other set of issues, of course, about natural things, natural capital, etc., that are problematized simply by the terminology. So there are two things that those other four papers describe, that is, two essential elements of a Marxian theory of interest. That is, number one, a minimum or maximum range of interest, that is, a rate of interest, derived from the fact that interest is paid out of profit. Now, what we're looking at, of course, is the difference among time periods, etc. And number two, secular and cyclical correlations between the interest rate and the rate of profit. So in particular, there's a formal model, and he goes in detail. Panico extends the central Leontief input-output model to incorporate a banking sector and hence interest rates. There's a whole thing that it can and should be done or must be done, and allows us to continue using Leontief input-output tables, etc. And then cyclical and secular relationships among profit, rate of profit and enterprise, and the interest rate, and the general interest rate derived from the circuit of capital that includes, of course, bank capital. And then Hine, 2006, attempts to combine the Marxian theory of money and interest with a Kalekian model of growth and distribution, which is a whole nother thing that we're not going to talk about today. So this is similar, in talking about Marx's monetary theory, to a horizontalist version of endogenous money theory, as opposed to exogenous, right? So the interest rate in this case, is an exogenous variable from Hein into both saving function and investment function. This is going to, it gets really, well, we could do it a whole thing on here. We're not going to do that. But by identifying Marx's monetary theory with the extremist version of endogenous money theory, Hein leaves no room for explaining the determination of the interest rate within the model. And so part of this whole thing is being able to figure out what counts as interest rate, which is where all the math comes in, or one reason why the math comes in. And then there's a discussion of Dembski, et cetera. Dembski does a taxonomy or typology, a whole bunch of other things, and I've skipped the math to get to the end. Although this little figure is useful to think about because that's kind of, that what rotates around the center here, 0 to infinity, money capitalists on the left, industrial capitalists on the right, and sort of the center, of course, is a division between money capitalists and industrial capitalists. Some of us would prefer, industrial capitalists on the other side, but anyway, the range of labor productivity, B, as you can see in there, and the technology threshold, double B, the levels of B in parentheses are in case assumption 1 is adopted. One of the important messages of lemma 1, which is this thing here, this is why it gets kind of, sort of irritating to think about, but, but that's the way the math goes, is that in an economy with a technology heterogeneity, the credit system makes a Pareto improvement within the capitalist class. This is uncontroversial. In the absence of a credit system, all capitalists have no other option but to manage their money capital endowment as industrial capital, so using the given technology, and so we get to a bunch of other things, the multiple period, the thing to get from this, because I know we're going to run out of time, is about issues of liquidity, which is kind of the big Keynesian thing. And so I included all of that to explain stuff. And a further part model done with a co-author, Thomas Mitchell, or Michel, is on shadow banks, which are sort of what allows all this movement to go on. On the one hand, you have a kind of banking of a primitive type or a simplified type, which is the so-called Jimmy Stewart Bank, which oversimplifies how the Depression operated or the crash, et cetera, and is a obvious, mythological version of how banks operate. Or it shows the divisions between big and small banks in that sense, and which still goes on actually, but in probably more complicated ways. So the point is that there are shadow banks, and it's defined as money market funding of capital market lending. So a substantial amount of money market funding for shadow banks takes place through the repo market, where agents exchange cash for collateral. This is where, collateralized debt, which we joked about before, usually treasury debt, and typically overnight or for short terms. Dealer banks, also called broker dealers or investment banks, this is the crux of the current investment crisis, essentially. But anyway, participate in the repo market both as a borrower and a lender. First, as a market maker in the capital market, dealer banks borrow from the repo market to fund their inventories of securities. But they also provide repo lending, called reverse repo, to leverage asset managers such as hedge funds. This is where, the crux of the current, issues of the economy are. The collateral the dealers take in through reverse repos can be repledged or hypothecated again. So, this is the technical weeds because we get to rehypothecation. So, but the point is, ultimately, and all of this has, management issues, and of course is problematized by issues with the FDIC and the Fed. Um, and so you have different versions or segments of the repo market, et cetera, et cetera. All of these are intermediation activities and have a whole variety of ways in which you can think about the basic issues of assets and liabilities. And you can see all the abbreviations here that come in this particular article. And I left out a whole bunch of stuff. There's general collateral financing, secured overnight funding rate, cash portfolio manager, risk portfolio manager, etc. And um, so there is this idea of a collateral multiplier that is a similar to money multipliers, etc. And it has to do with the relationship among these different categories. Let's put it as kind of categories. And so repurchase agreements are also part of this business, what we referred to prior as repos. Sale and repurchase agreements, form of secured short-term borrowing, usually, but not always, using government securities as collateral. A contracting party sells the security to a lender and by agreement between the two parties repurchases the security back shortly afterward at a slightly higher contracted price. And lest you think that's not important, the differences among these things are kind of what's going on with our current little oil crisis. I mean, not identical, but there's a lot of part of the system of monkey business that's going on, including diverting funds not to the treasury, but to some bank in Qatar, whatever that means, with Venezuelan oil profits. But that's another story. Because monkey business is happening in that particular context that we don't really know or see, and which require better oversight. Let's put it that way. Now, ROE is return on equity. That is a financial ratio that compares the net income generated by investors' capital, indicating how efficiently capital is utilized. So, you have returns on investment, you have returns on equity, et cetera, et cetera. So all these little things that are all part of the kind of calculation of this. And I think the point of these articles, at least my idea about them, it's a literature that doesn't, probably because it is fairly complicated, but that supports. Now, so we looked at government bonds last week, and so this week we're sort of implying anyway, we're not looking at it that seriously, but we need to acknowledge it about how private capital operates. And we know, of course, that there's kind of combinations of these things and people who abuse the privilege. So, for example, uh, you know, uh, they don't just simply pay out to the company cash on the barrelhead to resurface your reflecting pool or rebuild your helipad or cancel or have them rip out a helipad to try and make it more level, whatever the hell that means, because it doesn't have to be, a helipad does not have to be level. It's the whole point of helicopters. But anyway, um, but that's what's happening now. So Bob Meister's article, Reconceiving Marx for an Era of Financialization, may be the last thing that I get to today. And his treatment of this is more from the idea that certain ideas about justice are important. And so we'll close with sort of talking about this and get back to the front end. The point he's making, which is no different than the issues above, that is in credit debt, is about liquidity. And ultimately, there is a Marxist position on liquidity, which we'll get to, that we have to discuss. Because it is important. It's a key Keynesian point and clearly important for post-Keynesian thinking. So it's all there. Finance is the name that capitalism now gives itself when understood and lived from the point of view of the investor for whom the easy convertibility of any asset into money, that is, its liquidity, that's the current issue engaged in the Hormuz Strait stuff. It's about, a lot of it's about liquidity, is logically distinct from whatever utility that asset may have. The word utility is problematic here as well. But anyway, what many critics, especially Marxists, profess to find most objectionable in the transition from industrial to financial capitalism is the lack of utility in many financial products. That's not really the reason, but well, we'll just follow his argument here. I'm not sure that it's about lack of utility, but whatever. Especially derivatives. Now, derivatives are part of the big problem. It's part of, what makes hedge funds a problem, and et cetera, that are manufactured for the sole purpose of being liquid, and that are now large-scale repositories of accumulated wealth. So you could, talk about liquidity relative to crypto, et cetera. But why should we, who are living at, there's a lot of stuff I skipped here. We're getting to the end, because I want to end fairly quickly and or soon. But why should we, who are living in a world dominated by finance, go back to Marx? The reason, put bluntly, is that for Marx, the whole point of extracting surplus value from commodity production, it's not as simple as that, is to transform that surplus value into what we now call an asset. So there's an argument already there that is in a set of assumptions about the relation of surplus value to assets. And, we covered that before when we talked about the difference between tangible and intangible assets. And there's a way in which you can talk about it and think about it that makes it more, it has a lot of, variety, let's put it that way. An asset is a vehicle through which surplus value is preserved and accumulated, among many other things. If surplus value could not be preserved and accumulated in the form of assets, that is capital, it would not be produced. That finally is why Marx named his book Capital, rather than, for example, the commodity, even though that is more directly the principal object of analysis, at least in volume 1. Capitalist production is, both in its abstract form and historical origin, an activity that can be, and always could have been, financed by producers who had no initial ownership of the means of production and no initial control over their labor force. That's certainly possible. A capitalist farmer, quote unquote, could, in principle and practice, have rented the land from a feudal lord and borrowed the money to buy seed. He should have put in a note here on tenancy, but anyway, he could have, and sometimes did, pay for the seed only if the crop itself was able to function as security for that debt. The future crop was thus potential collateral. Now you can already see that some of this is sort of going through the minds of people like Marx and Ricardo about some of these issues. So the future crop was thus potential collateral even before it was a commodity. And so two financial products, that is the debt and the security, were created alongside the consumer product for which there was a ready market. If, in fact, the capitalist ended up owning the means of production, that is, both the seed and the land, this was only because these came to function as vehicles for holding and accumulating the surplus created in earlier rounds of production. The means of production would also, at this point, become financial assets that could themselves be pledged as collateral for future debt, and thus material for creating new financial products that existed alongside the commodities they were used to produce. So let's say you made metal stuff, and you suddenly need need, as opposed to want, a computer numeric control machine to do what it took, X number of people to, in milling machines and blah, 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 blah. A CNC machine could do all of those things, or many of those things at once. But the fact is that, it's really the front end is really an expensive piece of equipment. You have to have someone trained in how to do it, to use it, to program it, et cetera, et cetera. So in that sense, you need to, take out a loan. The fact that financial products are not merely instruments of circulation that sometimes fetishize, needless to say, but also vehicles for accumulating real wealth is the problem Marx addressed when he tried to explain how capitalism could have arisen at specific historical moments. And this is relative, of course, to his appealing or studying the physiocrats and et cetera, et cetera. Any serious rehabilitation of this theory needs to be initially concerned with the role that an asset market for capital has always had in the ongoing reproduction of a commodity market, that is, for goods and services. So today, we need to be concerned with how financialized capitalism is a system in which accumulated wealth depends upon market liquidity in financial assets that can grow independently of the output of useful goods and services, so often referred to as the quote unquote real economy. Now, this may or may not be the same real economy that Anwar Sheikh talks about, et cetera, et cetera. So there's a lot of things we need to sort of work through. But for Meister, the fact that the value of asset markets can grow independently of output, and that's a logical question as well. Do asset markets grow independently of output? Logical truth about capitalism resulting from the fact that production has to be financed in a way that makes it possible to accumulate the surplus. But whether there's a fundamental tendency in capitalism that asset markets grow faster than output is also a historical question. So there's all kinds of contingencies. Marx himself thought that industrial capitalism, but not necessarily its earlier forms, created rapid accumulation of physical capital alongside widening disparities of wealth. Left Keynesians argued that both economic inequality could be curbed by taxation and public spending while promoting and smoothing out capital expansion. The underlying question of both Marx and Keynes is how to conceptualize growth of asset markets on the one hand, and the widening of socioeconomic inequality on the other. And essentially, that's the same argument that Piketty is trying to produce. So, and what he's trying to work through here is the difference between, why asset markets tend to grow faster than the economies that supposedly underlie them. And of course, that's about liquidity. Is the differential growth something real that can be harvested to fund public goods, which is why we were looking last week at public debt in this same fictional context? Or must it be regarded as a fiction or excrescence, which that's kind of cool to use that distorts the real relationship between the accumulation of surplus value and rising output, something that will just simply vanish before it can ever be appropriated. So there is this question of that gets confused between things that are paid for and things that retain a certain kind of value. And there's lots of different ways in which that material immateriality is preserved or made constant anyway in the process. So we'll get along to this eventually. And he goes further and talk because he's a Rawls scholar. He was worried about justice, and justice in that sense can be more voluntary in that particular way. So I did a couple of things on collateral multipliers and stuff. And at the beginning, to remind you what and where we were operating, Scheist. I did this again. I did this the last time. Just to remind you what we were doing, we're looking at other sides or elements of fictional capital. So we're sort of filling out what Durand and Orleans were looking at a couple of weeks ago, and that fictional capital is a very powerful entity, even though it has the word fiction, and it's not about that, the phonic part of it. It is about how it is ubiquitous, or even though it's sort of, it can be thought of as spectral in that sense, and it's really important. It's part of, it's fully integrated with the with current capitalism. And you could argue, and that's a whole nother body of research, that um, it existed in earlier modes of production. So let me hurry up because I need to quit. Thank you very much for your attention. And we have other things to do. So we're going to close out.